Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, debt funds have been struggling for a while, but thankfully there are some positive signs visible now. There's been an uptick in the yield to maturity across debt fund categories. But what is this yield to maturity? What does it mean to a debt fund investor? Does it mean that the returns are going to go up here on? We'll tell you all about it in today's episode. Stay tuned.
There is a very funny relationship between debt funds and interest rates. When interest rates go up, the bond funds actually generate less return. Let me explain you why. Assuming that there is a bond fund and that bond fund has a set of bonds which are yielding 8%, that is the prevailing interest rate. And tomorrow interest rates go up and interest rates become 10%. That is what has happened. In fact, interest rates have gone up by 2%, nearly 2%, 1.9% in the last 1.5 years. But assuming it goes up by 2%, which means that all the new bonds which will be available to investors will start earning 10%. If you hold that 8% bonds, that will be worth far less. It will go down in value and the price will be adjusted so that the yield on that bond matches today's 10%. So if somebody buys the old bond, he will also get 10% because the new bonds are now yielding 10%. So that is why when interest rates go up, bond prices go down, and that is what has happened to these bond funds because they were holding bonds and it went down in value. Now this started happening ever since the initial phase of COVID. The central bankers were worried about the growth or the collapse of the demand, and that is why they went on reducing the interest. So we saw that interest rates really came down and the bond prices benefit. They did benefit. They appreciated, and that is why they gave more return. And from that more return of 8.5% from short-term bond fund in 2020 to 4.5% average return in 2021, and now it has virtually collapsed. And now I feel that it has come to a level where things are stabilizing. Interest rates are unlikely to go up very substantially from here on. We have already witnessed a very big decline or increase in interest rates, and they are at a reasonably high level. And if inflation is tamed, then things could change, or they are pretty close to their point of stabilization. Debt funds are beginning to make a comeback, and actually the early pointer is when the yield to maturity, what is in the bond fund jargon referred as YTM, actually starts moving up, and it is beginning to move up. And if you look at, let me just explain you what YTM is. YTM is if you own a bond, and this bond, bond typically has three things. One is what is the quality of bond, who is the issuer. So government is the issuer of the bond. It is considered to be highest quality. A great company which is a financially rock solid company issuing a bond, it carries a rating of AAA, it is considered good. Then there are poor companies. So that is the credit rating is the yardstick on which the quality of a bond is measured. Then comes maturity. There could be a bond which has a maturity which will mature after 25 years or 10 years or 15 years or 5 years. If a bond is going to mature in 6 months time, 1 year time, 2 year time, the likelihood of that being the predictability or the likelihood of that less uncertainty in realizing the worth of that bond is far higher. And what was the coupon, what was the interest rate on that bond till you hold it? And for the residual period, if the bond has a leftover maturity of 2 years, assuming there was a 5-year bond, 3 years are gone by, you are left with 2 years. And in these 2 years, what is the maturity? What is the yield? If you buy it now and hold it till its maturity, what will you earn? That is YTM, and that is beginning to go up. That is an early signal that interest rates have started moving up, or the yield has started moving up, and bond funds are might start yielding better returns from here on. It will be very much in line with the YTM. The YTM will actually, YTM less expenses should ideally be the realization. But there are many other variables here, which is, what kind of redemption or inflows the fund is witnessing. If a lot of people start putting their money, then the current portfolio will get diluted. So because these are all open-end funds, but the bond market is reasonably broad, and I would imagine that the bond funds prices or bond funds realization will be very much in line with the YTM, and it will be little more than the expenses that we see. Generally speaking, the return from a short-term debt fund is likely to be whatever is the YTM less the mutual funds expenses. But you can't really bank on it, because the open-end funds, they witness inflows and outflows. So, and in case of closed-end fund, the FMPs and other things, the target maturity funds, where the flows are predictable, or they are frozen. It has far greater predictability because the portfolio is unlikely to change. The portfolio is unlikely to get altered. In case of closed-end fund, it is more predictable because there is no uncertainty of money coming in and out of the fund. Get anchored to short-term debt funds only. Long-term debt fund could be very injurious, because when interest rates go up, these funds take a serious hit, and the longer the maturity, bigger the hit. So if a fund is holding a 25-year maturity paper, it can well go down by 5, 7, 10%, and you may not have that understanding that why it has taken a hit. So one should be very careful of that, and you should also not try to benefit from the reverse of it. When interest rates go down, which at some point in future they will, that is when these funds also appreciate substantially. That is when some of these funds will also give you 12%, 14%, 15% return, and don't get attracted to it because of the recent high return. Recent high return could be risky in case of bond fund. There is one thing, there is a new thing which has emerged as a category among debt fund, which is the target maturity fund. They are also reasonably predictable, and they are worth considering. So your ambit should be keeping it simple: short-term debt fund and target maturity fund. Target maturity fund, you should look at the ones which matches your need requirement. 2 years, 3 years time frame, pick the fund which matches with your needs.
Well, that's it for you in today's episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Thanks for watching. Bye for now.